Listen carefully because what I'm about to say is not another opinion, not another chart, and not another recycled narrative you've heard 100 times. There is one number, just one, that has tracked and predicted every major explosive move in gold and silver over the past 100 years. Not most of the time. Not only under perfect conditions. Through world wars, economic collapses, monetary resets, and financial crises that wiped entire industries off the map, this number signaled, and the metals responded. Every single time. And right now, today, that same number is doing something it has only done 3 times in a century. It's falling, sliding towards zero, approaching a level that historically marks the edge of a system shift. And when it crosses that line, and the data suggests we are now weeks away, not months, history doesn't give you a range of outcomes, it gives you one. A violent, sustained revaluation of physical gold and silver, and a massive transfer of wealth from paper holders to those positioned in real metal. This isn't technical analysis. This isn't speculation. This is a structural force embedded inside the global monetary system, driven by math, not emotion, and it has operated flawlessly for generations. That's why I'm recording this now. Because the window between understanding the signal and watching the opportunity disappear from the price chart is measured in weeks. And what you're about to hear may be the most important thesis I've ever laid out. Right now, it's already in motion. Before we go any further, let me be absolutely clear about something. I'm Asian, and this channel does not operate the way most financial channels do. We don't show up every time silver moves 2%. We don't chase headlines. We don't react to noise. What we do is track the structural mechanics that have driven gold and silver for decades, and we speak only when those mechanics align with timing, and this is one of those moments. What I'm about to walk you through isn't new. It's the same core thesis I presented recently at a closed-door precious metals conference in Warsaw, a room filled with institutional players, metal specialists, and serious long-term holders. And across every conversation, one theme dominated above all else: not short-term price charts, but the underlying mechanism, the repeating pattern embedded beneath every major bull market in gold and silver throughout the modern financial era. By the end of this video, you will fully understand that mechanism. You will see exactly what the current data is signaling clearly, without distortion. And more importantly, you will understand why the sharp silver drop in late January and early February this year was not a breakdown. It was accumulation. Let's go deeper. If you want to understand what's happening to gold and silver right now, you need to understand one force first. Not the headlines, not the price charts. The driver behind everything. It explains why central banks keep accumulating gold. It explains why silver refuses to stay below $70 despite repeated pressure. And it explains why this environment isn't just favorable. It's structurally identical to every explosive metals bull market in modern history. That force is real interest rates, not what banks advertise, but what you actually earn after inflation. If you earn 2% and your cost of living rises 6%, you're not gaining. You're losing silently. Your balance goes up, your purchasing power goes down. That's the illusion that keeps capital trapped in paper assets. But when real rates fall below zero, holding cash becomes a guaranteed loss. And when that loss spreads across the entire system, capital moves. It always moves. Into real assets. Into things that can't be printed. And for nearly a century, nothing has absorbed that shift more consistently than physical gold and silver. Every major bull run has been preceded by 4 signals always together. Signal 1 is already here: debt beyond mathematics. Not just high, but unpayable. Governments don't default, they devalue. Always. From Franklin D. Roosevelt in 1934, to Richard Nixon in 1971, to modern quantitative easing, the language changes. The mechanism doesn't. And today, with U.S. debt approaching $40 trillion, the path is already chosen. Right now, the rules of the system are being rewritten in real time, and almost nobody is talking about it. In the U.S., new policy frameworks are quietly forcing stablecoins to be backed by government debt, using crypto as a channel to create artificial demand for treasuries. At the same time, the Federal Reserve, which promised to shrink its balance sheet, reversed course in December 2025, and has been creating new money consistently to absorb excess debt issuance. Not because the economy needs stimulus, but because the market can't naturally absorb the supply. That's signal 2. The rules are changing. Signal 3 is now approaching ignition, real rates falling below zero. As of April 17, 2026, they sit near 0.4%, the lowest since 2023, but with aggressive bond buying suppressing yields. While real inflation runs higher, the math points to negative territory within weeks. Not speculation. Mathematics. Signal 4, central banks buying gold, 15 straight years. Nearly 1,000 tons in 2025 alone, from Poland to China to India. Sovereign balance sheets are rotating out of paper and into something they can't print, and when all 4 signals align, history doesn't drift, it reprices. Gold confirms the move. Silver is the opportunity, because while gold has already adjusted to monetary decay, silver remains compressed, carrying both a monetary breakout and an accelerating industrial demand story across solar, EVs, defense, and communications. Demand is rising into a supply base constrained by geology. That's not bullish. That's explosive. And understand this, institutions don't announce positioning. They move quietly through policy, logistics, and balance sheets. By the time price confirms, the move is already underway. Right now, the early signals are there, hidden in plain sight. Pay attention, because what's happening right now isn't random. It's coordinated, structural, and already underway. Refineries don't turn away silver without a reason. The simplest explanation: capacity is being absorbed through off-market government contracts, structured accumulation that never shows up on public pricing feeds. At the same time, institutional infrastructure is being built. Partnerships, processing plants, supply chains, positioning before the move becomes visible. Then look at the data. A major producer reported selling silver at a 25% premium to market price. That doesn't happen in normal trade. Pay attention, because what's happening right now isn't random. It's coordinated, structural, and already underway. Refineries don't turn away silver without a reason. Global M2 has exploded past $100 trillion, over 6x growth in 25 years. But silver supply? Flat, rigid, geologically constrained. This isn't a market, it's a fixed tank being filled with exponentially expanding liquidity. And when capital floods a physically constrained asset, price doesn't drift. It compresses, then goes vertical. Gold absorbed the first wave. Silver, much smaller, far less liquid, is next. This isn't optimism, this is arithmetic. Listen closely, because what you're seeing right now is not a new cycle. It's an unfinished one accelerating. Every major gold rally in the past century followed the same structure. From $35 to $850, from $250 to $1,900, and now from $1,500 to nearly $4,800, and behind every move, without exception, the same 4 signals appeared: unsustainable debt, rule changes, negative real rates, and central bank gold buying. Those conditions were never resolved after 2002. They intensified. Global liquidity exploded. U.S. debt surged toward $40 trillion. The system didn't heal, it expanded the imbalance. This isn't a new bull market. This is the continuation. And now we're entering the phase that historically drives the most violent upside: real rates moving below zero. Look at silver. It refuses to stay below $70. That's not random, that's a structural floor being defended by informed buyers. But the real signal isn't in price, it's in behavior. Governments are building infrastructure, institutions are paying premiums, supply is being quietly absorbed off-market. This is not balance, this is accumulation. And when shrinking supply collides with monetary pressure, price doesn't rise slowly, it reprices fast. The clock isn't measured in months, it's measured in weeks. Listen carefully, because when this crossover hits, the sequence doesn't pause, it activates. Capital sitting in savings and short-term bonds begins to move. Not slowly, urgently. Gold absorbs the first wave as monetary refuge. Silver follows, but in a market far smaller, far tighter. And today, the scale of money involved is unlike anything in history. Back in 2002, Global liquidity was $16 trillion. Today, it's over $100 trillion. But silver supply? It hasn't multiplied. Not in mining. Not in reserves. Not in deliverable inventory. That mismatch doesn't produce a gradual rise. It produces vertical repricing. And don't get distracted by this week's headlines. Geopolitical tension, oil spikes, Hormuz risks will be framed as negative for silver. That's the wrong lens. Historically, higher energy prices accelerate investment into solar, infrastructure, defense, every sector that requires silver. Governments respond by spending. And they don't fund that spending with savings, they fund it with new money. More currency, weaker purchasing power, stronger case for real assets. This is not instability that kills the bull market. It's fuel. Real rates are approaching zero fast. When they break below, the system shifts. And here's the difference that matters. Paper silver still sits inside the system you're hedging against. Physical silver ends that chain with you. No counterparty, no policy risk, just ownership. The signal is triggering. The window is open. Make sure you're on the right side of it.